Ever feel like you're staring at a huge financial jigsaw puzzle? Thousands of pieces, and they all kind of look the same. You want the big picture, sure, but maybe not a full-blown investigation of every single piece. Sometimes you just need someone to, help put the main parts together
Efficiently.
efficiently. Well, that's exactly what we're diving into today. It's a really crucial, but often kind of misunderstood accounting service called preparation engagements. Our mission here, give you a clear shortcut, help you understand what these are, how they actually work, and what makes them so different from other accounting stuff. Think of it like getting a really well-organized, accurate snapshot of companies' finances. But crucially, without that intense scrutiny you get with a full audit.
Yeah, that's a great way to frame it. It's like having a professional prep chef. They chop everything, measure it all out, organize it perfectly according to the recipe. That's their job. But they're not the one tasting it for quality control or, say, judging if it's the winning dish. Their focus is just ensuring everything's ready, structured right, accurately presented for whatever comes next.
That analogy works perfectly, sets the stage nicely. Okay, so let's get right to the core then. What's the main objective? What's the real purpose behind a preparation engagement from the accountant's point of view?
Fundamentally, the accountant's goal here is to prepare financial statements. Simple as that, almost. But crucially, they have to prepare them according to a specified financial reporting framework. That means making sure all the financial data is laid out clearly, correctly, following a recognized set of rules, like JAP, Generally Accepted Accounting Principles, which is standard here in the U.S. It's really about bringing order and clarity to the numbers based on those rules.
Got it. And what's the playbook they use? What are the actual rules accountants have to follow to do this properly?
Right. They operate under something called SRs. That stands for Statements on Standards for Accounting and Review Services. These are the specific professional standards that dictate exactly how these kinds of engagements need to be performed.
SRs. Okay, so that's the compass. But what about those times when an accountant is putting together financial statements, but it's not considered a preparation engagement under these rules? When do these SR standards not apply, even if financials are being prepped?
Yeah, that's a really key distinction. It helps zero in on what this service actually is. So the SR's preparation standards don't apply if the accountant is already doing a higher level service. Think an audit or a review or even a compilation engagement for those exact same financial statements. They also don't apply for certain specialized services. Things like preparing statements only for the tax authorities, or if it's for inclusion in a personal financial plan the accountant is putting together, or if it's tied up with litigation support, legal proceedings,
Yeah.
or alongside business valuation services. Those are all separate things.
Ah, okay. So back to the chef analogy. If the chef is already tasting the dish for quality, like an audit,
Okay.
or helping figure out its market value, like a business valuation, then just prepping the ingredients isn't really the main service anymore.
Precisely. It's a very specific, kind of narrow slice of what accountants do.
Makes sense. And here's where apparently our sources point to a passkey insight, something really critical to understand about these engagements.
Yes, the pass key. And it's a big one. A preparation engagement is a non-attest service.
Non-attached.
This is a huge difference because it means the accountant doesn't need to determine if they are independent of the entity. That completely sets it apart from audits or reviews where, independence is absolutely fundamental. It's the bedrock.
Wow. Okay. So for you listening, if you're looking at statements prepared this way, what's the immediate takeaway from this non-attest status and the fact that independence isn't required? What should you know up front?
Well, it means that while the financial statements are put together professionally, following the chosen rules, they don't come with any kind of external verification or independent assurance. It's really about the clear presentation and organization of the information management provided. It's not an external stamp saying, yep, this is all accurate and unbiased.
That's a fundamental difference, isn't it? Like you said, bedrock stuff. It's like getting a map of a property from the owner versus getting one that's been independently surveyed and verified. Big difference in assurance.
Exactly.
So this leads us right to the ground rules. How do accountants make sure everyone involved, the client, management, understands exactly what kind of map they're providing? Why is setting up this understanding so crucial before any work actually starts?
Oh, it's absolutely foundational. You have to get this right from the start. This upfront agreement, it's formally documented in what's called an engagement letter. This makes sure both the accountant and the company's management are crystal clear on the scope of the work, who's responsible for what, and really importantly, the limitations of the service. It's all about preventing misunderstandings later on. It's basically a contract signed by both the accountant or their firm and the client's management.
Okay, let's unpack that a bit using the sample letter from our sources. It spells out objectives and, crucially, responsibilities. What does it emphasize about the main goal of this engagement?
Right, the letter clearly states the objective is just to prepare the financial statements according to the chosen framework, like GAAP. And critically, it's based entirely on the information the client provides. It also confirms the accountant will follow the SR's standards and stick to the AICPA's Code of Professional Conduct, ethics like integrity, objectivity, professional competence.
And what about the accountant's responsibilities? What's the absolute biggest limitation described in that letter? What should a business owner know the accountant is definitely not doing?
The number one limitation, the most critical one, is that the accountant is not required to and will not verify the accuracy or completeness of the information that management gives them. They aren't out there gathering evidence to form an opinion or reach a conclusion. So the letter explicitly states they won't express an opinion or provide any assurance whatsoever on the financial statements. And because of that, the engagement itself, by its very definition, cannot be relied upon to catch things like financial misstatements, whether they're due to error or fraud, or to detect if the company isn't complying with laws and regulations. That's a really specific core limitation of this service.
Wow, that's a huge distinction. So if a business owner thinks, great, these prepared statements will flag if an employee is stealing, they're completely misunderstanding the service.
Absolutely. That's not what this is for. It really hammers home the no assurance part.
Okay. So if that's what the accountant isn't doing, what about management? What are their absolute must-do responsibilities here? What do they have to bring to the table?
Management has several really key responsibilities. First, they have to choose the right financial reporting framework, like GAAP, for their specific situation. And here's a big one: the prevention and detection of fraud. That responsibility lies squarely with management, not the accountant in a preparation engagement.
Right, that's explicit.
Very explicit.
Yeah.
Management's also responsible for making sure the company complies with all the relevant laws and regulations. And crucially, they are accountable for the accuracy and completeness of everything they give the accountant, all the records, documents, explanations, even significant judgments they might make. And finally, they have to provide the accountant with all the necessary documents, any extra info requested, and unrestricted access to people within the company if needed.
That's a hefty chunk of responsibility right there on management's shoulders. It really sounds like this whole no assurance thing is just woven through the entire agreement.
Completely. The engagement letter makes it absolutely clear. Management agrees upfront that every single page of the financial statements will have a statement on it saying no assurance is provided.
Every page.
Every page. Or, if for some reason that's not possible, the accountant has to issue a separate disclaimer report to make sure anyone reading them understands this limitation.
Yeah.
It's fundamental to managing expectations about what these statements actually represent. Oh, and the letter also usually covers the practical stuff, fees, maybe some language about limiting liability, although regulators sometimes put restrictions on those.
Okay, so the ground rules are set, the letter is signed. Let's talk about actually doing the work. Before an accountant even starts prepping the numbers, what kind of knowledge do they need about the client's financial world?
Well, the accountant has to get a solid understanding of two main things: the entity's financial reporting framework, the rules they're following, like GAAP or maybe cash basis, and the significant accounting policies the company uses. Now, this doesn't mean an accountant can only work in industries they already know inside out. They can take on new clients in new areas. But, and this is important, they are professionally responsible for getting the necessary knowledge to do the job competently.
Right, do care. And while they're preparing the statements using management's info, what if the accountant actually helps management make some, big judgment calls? Decisions about how certain numbers are categorized or presented?
Good question. If the accountant assists management with those kinds of significant judgments, deciding on specific amounts or disclosures that go into the financials, those judgments must be discussed with management. It's absolutely crucial that management fully understands those judgments and explicitly accepts responsibility for them. The accountant might assist, but the decision and the responsibility ultimately rest with management.
Okay, that makes sense. Now, we keep coming back to this no assurance point. We talked about agreeing to it in the letter, but how does it actually look on the financial statements themselves? How does someone reading them see this rule in action?
It has to be visible. It's a key requirement. A clear statement saying no assurance is provided must be included right there on each page of the financial statements.
Each page again.
Well, yep. You'll typically see phrases like, just simply, no assurance is provided on these financial statements.
Hmm.
Or maybe a slightly longer version like, these financial statements have not been subjected to an audit, review, or compilation engagement, and no assurance is provided on them. Okay. And interestingly, the accountant's name, or their firm's name, is not actually required to be on these prepared statements.
Huh. Okay. But what if, just practically speaking, they can't get that statement onto every single page, maybe formatting issues or something?
If they can't include it on each page, the accountant has a few very specific options they must follow according to SESARs. They have to either issue a separate disclaimer report, a standalone document clearly stating no assurance is provided, or they could potentially upgrade the service, you could say, and perform a compilation engagement instead, which is a different service with its own set of rules and reporting. Or, as a final option, they must withdraw from the engagement entirely and tell management exactly why they're withdrawing. For instance, that sample disclaimer report we mentioned, it would state very directly something like, the accompanying financial statements were not subjected to an audit, review, or compilation engagement by us, and accordingly, we do not express an opinion, a conclusion, nor provide any assurance on them. Very blunt.
Very clear. Okay, let's touch on a couple of special situations. What if the financials aren't using standard GAAP? What if they're prepared using a, special accounting framework?
Right, that happens. If the statements are prepared using what's called a special purpose framework, maybe it's cash basis or tax basis accounting, or maybe rules set by a specific regulator, then that framework must be clearly described. And that description needs to be prominent, either right on the face of the financial statements themselves or detailed clearly in the notes accompanying them. This ensures anyone reading those numbers understands the specific, maybe unusual rules they were prepared under.
Makes sense. Transparency. Now, what happens if the accountant, even though they aren't required to verify things, starts to suspect something isn't quite right with the information management gave them? That seems like a tricky spot.
It definitely can be. So while they aren't required to go digging or verify, the standards do say they may make inquiries or perform other procedures if something feels off. Now, if they actually discover that information provided is incorrect or incomplete or just unsatisfactory in some way, they must go back to the client and obtain additional or revised information. They can't just ignore it.
Okay, so they have to address it.
Yes. And furthermore, if, maybe after discussing it with management, the accountant knows they are preparing financial statements that contain a material departure from the chosen reporting framework, like a significant known error, they have two pretty stark choices. They must either clearly disclose that material misstatement right there in the financial statements themselves, or they have to withdraw from the engagement and tell management why. They can't knowingly issue misleading statements.
That's a really important ethical line there. Okay, now this next point from the sources, it sounds almost, well, wrong for financial statements. The idea of omitting substantially all the disclosures, is that actually allowed? And if so, how?
It is allowed, surprisingly enough. And yes, it does sound counterintuitive. If the client specifically requests it, an accountant can prepare financial statements that leave out almost all the footnote disclosures that would normally be required by the framework, like GAAP, provided, however, that the statements are otherwise okay according to that framework. But there are two absolutely critical conditions that must be met.
Okay, what are they?
First, the accountant must clearly disclose the fact that these disclosures are omitted. This has to be stated either right on the financial statements or in an accompanying disclaimer. Second, and this relies on professional judgment, the accountant has to conclude that leaving out those disclosures would not, in their view, make the financial statements misleading to potential users.
Interesting. So it's allowed, but with big caveats.
Exactly. You might see a note or a label that says something like, selected information substantially, all disclosures required by, say, GAAP are not included. That's the signal.
Got it. Okay, finally, let's talk documentation, the paper trail. Why is keeping good records so important in a preparation engagement, especially given all these limitations we've discussed?
Documentation is still absolutely vital even here. It serves as the concrete proof, the evidence, that the accountant actually followed the SR standards correctly throughout the whole engagement. It needs to provide clear details of the work performed, showing they exercise professional care and diligence, even within the limited scope.
And what specific things must be included in that documentation file? What's mandatory?
The essentials, the must-haves, are the signed engagement letter we talked about, a complete copy of the final financial statements that the accountant prepared, and documentation of any significant findings or issues that came up during the work.
Okay, the basics. Are there other things that might end up in the file, even if they aren't strictly required?
Yeah, there might be other things. For instance, notes about any conversations, written or oral, with management about potential fraud or non-compliance if the accountant became aware of something. Also, in really rare situations, if an accountant felt they had to depart from a standard Censars requirement that's usually mandatory, they would have to document exactly why they did that and how the alternative steps they took still met the goal of the original requirement. But that's uncommon.
Right. So let's pull this all together. Quick recap of what we've unpacked today. Preparation engagements. They're a distinct service, definitely not an audit or review. They are not a test. The main focus is putting together financial statements based on client info, following specific rules like GAAP. But the huge takeaway, no assurance is provided. The accountant isn't verifying accuracy or looking for fraud. They're governed by specific standards, SRs, and require really clear upfront communication, especially in that engagement letter, about who's responsible for what. Management's role, particularly around fraud, is critical, and that no assurance statement, it has to be on every page or handled through a disclaimer. This deep dive really shows how even a seemingly straightforward service has these crucial layers, responsibilities, limitations, specific rules. And hopefully this knowledge is really valuable for you listening, whether you're a business owner getting these statements prepared, or maybe you're someone who looks at company financials sometimes, or maybe you're just fascinated by how the accounting world works. This gives you a shortcut, right? A clearer understanding of this specific piece of the financial puzzle, highlighting exactly what these documents represent, and, just as importantly, what they don't represent.
Exactly. And it leads to a final thought, maybe something for you to mull over. Given that these preparation engagements don't require the accountant to be independent, and they explicitly scream no assurance on every page, what does that really imply about your responsibility as a user of these statements? How much critical thinking do you need to apply when you're interpreting them for your own decisions or just trying to gauge a company's financial health? Knowing the backstory definitely changes how you might look at them, doesn't it?
Absolutely. Definitely food for thought. Plenty to ponder until our next deep dive.